On January 29th of this year, gold touched an all-time high above $5,500 an ounce. 6 months later, it crossed $4,000 again, but this time it was falling, not rising. That distinction is the entire subject of this video, and it's one almost nobody is framing correctly right now. Before we go further, a quick note. This video is for educational purposes only. Nothing here is financial advice, and nothing here is a recommendation to buy or sell anything. Our job at Gold and Silver Analysts is to help you understand what's happening in the market and why. What you do with that understanding is entirely up to you. Here's why this moment matters. Most of the headlines you've seen this year treat $4,000 gold as a milestone worth celebrating, and in one sense, it is. 12 months ago, gold was trading near $3,300, so even at today's price, long-term holders are sitting on a substantial gain. But the story underneath that number is more complicated, and if you only pay attention to the price and not the shape of the move, you'll miss what the market is actually telling you. Let's rebuild the timeline because the order of events matters more than the price itself. Gold spent 2025 in what can only be described as a historic run. It gained more than 60% over the course of the year, the best annual performance for the metal since 1979. And it set more than 50 new record highs along the way. That run didn't stop when the calendar turned. It accelerated. By late January of this year, gold had pushed past $5,500 an ounce, an almost vertical extension of the trend that had been building for months. Then came the correction. Over the following months, gold gave back roughly a quarter of its value, and by late June, it had fallen back through $4,000 for the first time all year. The immediate trigger was geopolitical, a framework agreement between the United States and Iran, communicated publicly in a way that reduced fears of a prolonged conflict and disruption to shipping through the Strait of Hormuz. When that fear eased, so did one of the pillars that had been holding gold up. As of the most recent data available, gold has been trading in the low 4,000s, hovering right around the level that the World Gold Council's own valuation model treats as fair value for the current environment, a model that weighs real interest rates, inflation expectations, the strength of the dollar, and central bank demand. So here is the uncomfortable part, the part that doesn't fit neatly into a celebratory headline. Gold at $4,000 today is not new strength. It's the market finding a floor after giving back a large chunk of an extraordinary rally. Anyone who bought near the January peak is currently sitting on a paper loss of more than 20%. That's not a reason to panic, and it's not evidence that gold is broken. Corrections after parabolic moves are common and, historically, healthy. But it is a reason to be precise about what gold at $4,000 actually means, instead of absorbing it as good news by default. It's worth pausing on why a round number like $4,000 carries so much weight in the first place, because this isn't just a psychological quirk of headline writers. Round number levels tend to accumulate real trading activity around them. Buy orders, sell orders, and options positioning all cluster near levels that are easy for the human mind to anchor to. When a market approaches a level like that from above, as gold has done this year, it often behaves differently than when it approaches from below. The World Gold Council's own valuation framework has effectively confirmed this by treating $4,000 as the lower edge of a broader fair value range rather than an arbitrary line, with a tolerance band that stretches from roughly $3,900 up toward $4,300. Slip meaningfully below that band, and the model itself suggests the risk of further selling increases. Hold within it, and the range represents rough equilibrium rather than a market in crisis. That's a very different framing than gold crashed or gold hit a milestone, and it's the framing that actually helps you make decisions. Silver has followed a strikingly similar arc, and it's worth mentioning here because so many investors in this space hold both metals together. After trading near $60 an ounce earlier this year, silver pulled back alongside gold through the same stretch of geopolitical de-escalation and rising real yields, and it did so with noticeably more volatility. That's typical. Silver has historically moved with higher beta than gold, meaning it tends to rally harder during the up moves and fall faster during the corrections, because its market is smaller, more industrially exposed, and more sensitive to shifts in risk appetite. If you're holding both metals, understand that silver's swings are not a separate signal from gold's. They're an amplified version of the same underlying story, and treating a sharp silver drawdown as unique bad news, disconnected from what gold is doing, is a common way investors talk themselves into decisions they later regret. This is where a bit of history helps put things in perspective. In January of 1980, gold spiked to roughly $850 an ounce amid inflation fears, an energy crisis, and geopolitical instability. A setup that, in broad strokes, doesn't sound unfamiliar. What followed wasn't a quick recovery. Gold spent the next 2 decades grinding lower, not bottoming until it fell to roughly $250 in the late 1990s. Investors who bought at the top of that spike waited more than 20 years just to get back to even in nominal terms. Now, today's market is structurally different in an important way we'll get to in a moment, but the lesson from 1980 isn't gold always crashes. The lesson is that a sharp, emotionally driven top can look identical to sustainable strength right up until it isn't, and the only way to tell the difference in real time is to look past the price and study what's actually driving it. That brings us to the part of this story that most retail commentary is missing entirely. While the headline price was falling, the people with the most information about gold, central banks, were not selling. They were buying. Over the past 4 years, central banks around the world have added gold to their reserves at an average pace of roughly 1,000 tons a year, a scale of accumulation that has no real precedent in the modern era. And in June of this year, during what was actually gold's worst quarterly decline in over a decade, the People's Bank of China alone added nearly 15 tons to its reserves. Read that again. While retail sentiment was souring and the price was sliding, one of the largest sovereign buyers in the world was accelerating its purchases, not pausing them. That divergence is the single most important thing to understand about this moment. It doesn't mean central banks are always right, and it doesn't mean the price can't fall further from here. But it tells you something about how differently institutional players and everyday investors tend to respond to the same set of facts. Retail sentiment moves with the price. People get excited near the top and anxious near the bottom. Central banks, by contrast, appear to be treating pullbacks as accumulation opportunities within a much longer-term diversification trend, one tied to concerns about currency stability, sovereign debt levels, and reserve concentration in the dollar. Whether that trend continues is not something anyone can know with certainty, but it is measurable, it is ongoing, and it's happening largely outside the headlines that most investors read. Now let's talk about the macro backdrop, because gold doesn't move in a vacuum. Inflation data this year has been genuinely volatile. In May, the annual inflation rate jumped to 4.2%, driven in large part by a sharp rise in energy costs tied to Middle East tensions, a reading that pushed investors to price out interest rate cuts and even consider the possibility of a hike. Then, in June, inflation cooled sharply, falling back to 3.5%, with the monthly figure posting its steepest decline in years. That kind of whiplash, a hot reading followed by a cool one, is exactly the environment that makes gold difficult to trade in the short term and important to understand in the long term. Gold tends to respond less to any single data point and more to the trajectory of real interest rates, the gap between what bonds pay and what inflation is actually running at. When that gap narrows or turns negative, holding a non-yielding asset like gold becomes more attractive by comparison. When real yields rise, gold tends to compete less favorably against interest-bearing assets, and that's part of what pressured prices during the correction. Layered on top of that is a new variable: leadership change at the Federal Reserve. A new Fed chair has taken a notably more hawkish posture than markets initially expected, emphasizing a firm commitment to the 2% inflation target and pushing back on any suggestion that target should move. That matters for gold because it shapes expectations about how long interest rates stay elevated. As of the most recent policy meeting, the Fed's benchmark rate remains in a range of 3.5% to 3.75%, and market pricing currently leans toward rates holding steady in the near term. Though a meaningful minority of officials have signaled openness to a further increase if inflation doesn't continue cooperating. Every one of those data points, the CPI print, the Fed's tone, the path of real yields, feeds directly into how gold is priced from here. None of them, on their own, tells you where the price goes next. But together they tell you what to watch. Let's bring this down to something concrete. Picture an investor, we'll call him Daniel, who started buying gold in early 2025 as a hedge against inflation and currency risk. He added steadily through the year as prices climbed, feeling increasingly validated by each new high. By January of this year, gold made up a large share of his portfolio, and he was, on paper, doing extremely well. Then came the correction. By June, watching the price fall through $4,000, Daniel faced the exact question every long-term holder eventually faces. Is this the end of the trend or a pause within it? There's no way to answer that question with certainty in the moment. Nobody has that information, no matter how confident they sound on social media. What separates a disciplined investor from a reactive one isn't predicting the bottom. It's having decided before the volatility hit why they own the asset in the first place, and what would actually change that thesis. Daniel's original reasoning, currency debasement risk, sovereign debt levels, central bank diversification away from the dollar, hadn't changed just because the price pulled back 25%. A trader's reasoning might have looked completely different, and that's fine too. The mistake isn't holding through a drawdown or selling into one. The mistake is not knowing which kind of investor you are before the drawdown happens. So what should you actually be watching from here if you want to think about this clearly instead of emotionally? Start with real yields, the relationship between Treasury bond rates and inflation expectations, because that relationship has historically done more to explain gold's direction than almost any other single factor. Watch the monthly inflation reports, not just the headline number but the trend across several months, since single readings can be noisy and misleading. Pay attention to what the Federal Reserve actually does at its upcoming meetings, not just what commentators predict it will do. And watch the central bank purchase data that the World Gold Council publishes quarterly. Because, as we just discussed, that data has been telling a very different story than retail sentiment for over a year now. None of these indicators will hand you a perfect forecast. Nothing in markets does, but together they give you a framework for interpreting the next headline instead of just reacting to it. There's one more habit worth building, and it has nothing to do with charts or data releases. Whenever you see a big round price number attached to gold in a headline, pause for a second and ask which direction the market came from to get there. Gold hits $4,000 reads as exciting whether the prior print was $3,800 or $5,500, but those are two completely different stories, wearing the same headline. One is a market breaking out, the other is a market finding its footing after a sharp fall. Financial media, by necessity, optimizes for attention rather than context, and round numbers generate clicks regardless of direction. That's not a criticism of journalism, so much as a reminder that the responsibility for context sits with you, the investor. Get in the habit of asking, before you react to any price milestone, compared to what and coming from where. That single question will save you from more bad decisions than almost any indicator on this list. It's also worth being honest about where real uncertainty exists. Forecasts for where gold ends this year vary enormously depending on which institution you ask, with some banks projecting a moderate recovery toward the $4,500 to $4,900 range by year-end, and other more aggressive models projecting substantially higher targets. That spread itself tells you something important. Nobody actually knows, and anyone presenting a single confident number as certainty is skipping past a lot of complexity to get there. The honest position is that gold sits today at a genuine inflection point, close to a model-derived fair value, supported by structural central bank demand, but still vulnerable to further downside if real yields keep climbing or if geopolitical tensions continue to ease. That's the warning underneath the headline. Not that gold is doomed and not that it's guaranteed to keep climbing, but that a price crossing $4,000 on the way down carries a completely different meaning than the same number on the way up. And conflating the two is exactly the kind of mistake that turns a well-reasoned investment thesis into an emotional one. The number on the screen is the least interesting part of this story. What matters is understanding the forces underneath it: real yields, central bank behavior, inflation trajectory, and Fed policy, because those are the things that will actually determine what happens next, long after this particular headline is forgotten. If this kind of analysis is useful to you, take a moment to like this video and subscribe to the channel. It genuinely helps us keep producing content like this. And I'd like to hear from you directly. Do you think gold's move to $4,000 marks a floor, or do you think there's further to fall from here? Leave your reasoning in the comments, not just your prediction, but why you believe it. Some of the best discussions on this channel happen down there, and I rate every one of them.